of Labor Statistics released the CPI report about a week ago. I wanted to show what my model looks like and some projections for the future, and certainly to realize the obvious of what happens each month now, where we're rolling off a fairly high monthly CPI number from a year ago and adding much lower rates of inflation. I also want to look at what the report sort of highlights as the biggest cause of the increase and dive into exactly what number that shelter is doing to the CPI report. So we had a non-core CPI number of 0.1% month over month, which certainly was good, and the overall year-over-year rate came down a fair bit. Again, this is largely due to dropping a fairly large increase a year ago and adding something very small. It's the effect of the month that's dropped is the biggest reason for this drop. So the report highlighted, and I'm going to dive into fairly soon, this shelter component as one of the largest contributors to month-over-month inflation. The other contributor is food, and that one I'm a bit more pessimistic of rolling off, but the shelter, it seems like a lot of people smarter than me think that that's rolling off, and certainly looking at the economy and housing prices and feeling the effect of much higher mortgage rates, whether it's fixed or variable, I don't see the shelter cost spiraling out of control. For the core number, it was up 0.2% month over month, and we are starting to see some deflation showing up in the economy. Used cars are certainly falling off. I think new cars are going to start falling off with these high rates and high auto loans. And then I was curious to see airfares rolling off. I didn't know if that was a good sign or whether that's just a seasonal thing of less travel in the fall. So this is the Bureau of Labor Statistics CPI month over month. So we have these 5 months now that are coming in much better, maybe not ideal. If we kind of average these out, we've got 1% in total divided by the 5 months. So that's coming in at sort of a 5-month average of 0.2% a month. Okay, so if we annualize this over a whole year, times 12, so this is 2.4% inflation on an annual basis. No, obviously this is not using a whole year of data. It's biased towards a half-year seasonal effect. So maybe the spring and fall is different, but that certainly seems to be to me to be a much more positive sign than the market's taking. So if we look at what rolled off in November, we had a 0.7% that was excluded from the 12-month average. And I definitely want to highlight what's coming up. The next 4 months or so, we've got 0.6 as our comparison from a year ago in December number, 0.6 again in January, and then peaking at, or 1 month off peaking, the max of 1.2 in March. So this is what's going to be rolling off the yearly CPI. Okay. So March was the second highest, June was the worst. Once we get to the end of June, then we're going to have much tougher year-over-year comparisons, but hopefully inflation will be much lower by the time we're rolling off this June month when we get the data next July in 2023. So this is the Bureau of Labor Statistics chart. So again, we're going to see these significant drops. We are next month going to be dropping this 0.6. So if inflation was 0%, that's not a projection, just an if statement, this is going to come down 0.6. So we're going to be down in the low 6s. The next month, if it was 0, we're coming down another, I believe, 0.6 or 0.7. It'd be another 0.6. Okay, so then it's what is inflation, but there's certainly a very strong drop coming if inflation can come in reasonable. So I keep tracking the month-over-month CPI and core CPI and the year-over-year. And towards the end of this video, I'll go through a few scenarios of what could inflation look like come the spring. So again, I want to highlight the month over month that's going to be dropping. These are the next 4 months. that are rolling off, fairly high inflation. So that's the CPI, and then similar in the core, not quite as big, but core inflation hasn't been quite as big or high as the non-core. So the report at the beginning, my second slide, talked about shelter being one of the biggest contributors. So Table 1 in the Bureau of Labor Statistics report sort of breaks down food, energy, and then sort of lumps the others all together in the bottom part of their table. So I'm going to zoom into the top part and second part and sort of highlight what the report was highlighting in the opening paragraphs. So we have food inflation, which contributes about 14% to the index. And this inflation is very sticky and really stuck fairly high. So we're coming in, quite high, 5, 6, 7% annualized rate of inflation. The previous year was coming in at 10. So I'm not very optimistic about food inflation. Energy, 8% of the index. This was sky high at 13%, and this has totally rolled off the last few months. It is slight deflation. Anything can happen with Ukraine and energy prices, but this is something that I'm certainly less concerned about. And when you think of oil at pushing $120 WTI, and now we're in the 70s, oil is going to be causing a lot of year-over-year deflation. So what about that shelter that was mentioned as one of the biggest contributors? So it is almost a third of the CPI index. And it's still coming in pretty red hot, as high as food is. When you look at all the numbers, it's certainly one of the big contributors, and particularly its weighting. Now, listening to people smarter than me, Jeremey Seigel has been on CNBC a few times, and just again, what I feel, I don't see housing prices, rent prices going up, but there's a huge lag, and Seigel talks about this. The big lag in the reports and the way the government tracks the CPI data of not seeing this. And again, you've got those 1-year rents, so it can take a long time before you feel it. And people aren't refinancing their mortgages all the time. I think Canadians feel it a bit more, where we typically have 5-year fixed rate mortgages, so they're constantly rolling off. So, every year, let's say 20% or so of those 5-year mortgages are rolling over. So if rates being high, or when they are high for a couple of years, that's a good percentage of mortgage holders. The US has more long-term, long mortgages. So I think Americans don't feel it the same as Canadians do. But this, I think, is going to be the biggest factor that can lead to deflation potentially coming whenever the shelter, let's call it no inflation or deflation, starts coming through. I thought this was an interesting table. I'm certainly not going through all the Bureau of Labor Statistics tables. This is the last one. They've got inflation less food, so that came in flat. So, let's say neutral, and then all our inflation on top of that is food, which looks pretty sticky, and I don't see dropping soon, particularly if the war in Ukraine. But if you look at all items less shelter, so you take out that shelter, that certainly Jeremey Seigel thinks is already rolling over. We're already in deflation last month, okay, and relatively low inflation the previous months. So this is what sort of gives me the most hope. We've got deflation with something that is likely to fall. If you take out food and shelter, those two sticky ones, were pretty, I think, clearly into some deflation. Again, I don't see a lot of hope with food, but I do see hope with shelter. So I just put together some projections, some what ifs. These aren't predictions, but what if inflation just stayed around this 0.2 for the next 6 months or so? What would that do? So in December, if we had 0.2 core and non-core, we're rolling off, 0.5s, 0.6s. adding 0.2, so that causes a drop of 0.3 or 0.4. And if this keeps happening, we're dropping relatively large previous year ago months, and the inflation rate could by May, if the month over month stayed at 0.2, sort of have our first 3 handle, which would certainly be a nice print. I think it'll be nice to see a 5 handle, and then certainly a 3. I don't know when we're going to see a 2 handle or a 2.9 on inflation, but potentially this spring we could be down around 4. Sort of want to look at a few other options. What if we keep bouncing around the 0.1, 0.2? Okay, we've had some zeros, some 0.1s. A bit more optimistic scenario, this would be the shelter part definitely rolling off quicker, and then we could certainly be into the 3s. I think this is a lower probability. But again, I'm just doing sort of what ifs or projections. Sort of the best case scenario, I don't know if shelter can roll off the government numbers this fast, but if we actually started to see some of this deflation come through in the spring, and again, not counting shelter, we're already last month seeing deflation at a negative 0.1, I believe. So if we flip back to table 3, all items less shelter, we were going down in terms of inflation. So we just need that shelter to at least go flat. Okay, if it goes flat, we could start printing some negative numbers. And if we start printing some 0.2s, 0.1s, and then finally negatives, then we're down solidly into 3. And I think we can start thinking of declaring victory with slightly negative month-over-month numbers. Again, I don't know if this is going to happen. I don't know if the shelter numbers are going to come through this fast. I think these numbers, if the shelter was coming through the numbers faster, this would be a likely scenario. But again, the lag, we may not see this, but the Federal Reserve might feel this type of deflation in the economy come spring. So that's sort of an optimistic view on this. What's negative is, or potential negatives are the strength of wage inflation and employment. But again, employment is a pretty big lagging indicator. So I think when that rolls over, we might already be well into recession. And I think I'd put wage inflation with the food inflation of those would be my biggest concerns of things being sticky. So kind of taking a look at what Jeremey Seigel says about house inflation to sort of wrap things up.
We're closed on Friday. Joining us now to talk about this, someone who I imagine disagrees vehemently, but we'll see. Jeremey Seigel, Professor Emeritus at Finance at the University of Pennsylvania's Wharton School of Business. Take on Goldman Sachs. Jeremey, what do you say, Professor?
Yeah, I think Goldman is. I respect them so much, but I think they're being way too pessimistic. Listen, it's taken way too long for the Fed to get it, and they haven't gotten it yet, that inflation is basically over, but they will. And I think they're going to get it maybe very late this year or early next year. And I think as soon as they get it, you're going to see a big increase in the equity prices.
What makes you so convinced, though, that they are going to shift, given how Jay Powell has said, and we've talked about it on this show over and over again, this idea, it's a little bit maybe like an antibiotic. You got to go for the full 10-day dose. That on day 7, it may look like you're feeling better. It may look like it, but, if you stop taking it, you could get sick again.
Well, next week, we're going to get the Case-Shiller monthly housing index as well as the federal index. Both are expected to show another big decline. And as you know, my point has been housing is declined, but the way the government computes it, and it's a very important part of the index, it's so lagged that it'll continue to show increases. And I think finally the Fed will say, you know what, on the ground, things are all declining, and we've got to think about that. But I was shocked when Jim Bullard said, just last week, I think things are getting worse, and now I feel I have to be even more aggressive. I really wonder what sort of data he's looking at. Tomorrow we're going to get the monthly money supply. As I think I've noted, we've had the greatest 6-month decline in the money supply since World War II. I expect another decline tomorrow. So monetary conditions are still extraordinarily tight. Once they get to the recognition, hey, what's going up in the real world, they'll say, we just don't have to tighten anymore. And we don't have to get into the five.
Professor, we just had the CEO of Smucker's on this morning. He seemed to be able to pass his costs on and then some to the customer base right now, right?
Yeah. I mean, there's certainly going to be pass-ons without any doubt. But when you take a look at the important part of the index, that housing index, which for the Fed is going up because of the way they construct it, in the real world is going down. 40% of the core index is this housing. So even when you take into account passing on, and I think it's true, many of them have passed on, but now their commodity costs are not going up anymore. I mean, there's some labor costs going up, but outside of that, I think basically 90% of our inflation is gone.
So just to sort of wrap things up and highlight one number, he talked about the housing being 40% of the core. So I was showing 33% of the non-core. So certainly it's a huge effect. I think before I really went through the report, I maybe underappreciated how important shelter is. I really feel food inflation, but as a percentage, it's just nowhere near as significant as the shelter is. So that's certainly one thing I'll be watching for. Certainly nowadays, look at the bond market before I look at the stock market. It's a pretty good way to know what's going on. If bond prices are up, stocks are probably down. The 2-year has certainly been declining for a while. So that is not showing signs that inflation is going to start running out of control. I kind of wanted to look back to where it used to be pre-pandemic. So the 2-year treasury sort of peaked out around 3, and then things weren't great in the market pre-COVID. There certainly was a big tech fall well before the COVID time, so it came down to around 2. So we're much higher in the 2-year yield than we were in the past. But again, certainly I don't know if it's rolled off for sure, but we certainly have a month or so of decreases. On the 10-year, we're not that crazy off where the 10-year was a year or so before the pandemic, in the high 3s, and we're just in the mid 3s. Now, again, right before the pandemic, the stock market and the bond prices went up, the yields went down into 2019. So, but, this range is not that far off the 10-year. So getting back to normal-ish or pre-pandemic-ish doesn't seem that far off. And I think the summary and closing of this video is that we just need the shelter numbers, which I don't think are as high in the economy as they are in the report, to start showing through in the report. This is not meant to be a bull video and start going out and buying things, but definitely think of positioning your portfolio both ways. There could be a recession coming, but if rates start coming down, it just seems like you don't fight the Fed. So if they're being held high and we go into recession, then certainly the equity markets will fall. But if the Federal Reserve starts cutting in the spring, recession or no recession, I would be thinking of wanting to add to my highest quality positions.